Okay, and those that are starting to come in, just give us a second. Get everything rolling here for you on this soon to be live webinar. Eric Hale giving us the thumbs up there. For those who are not familiar with Eric, you will be either by the end of this webinar or tomorrow, because he'll be with me at the New York Stock Exchange doing the closing bell. So that'll be a fun, exciting time. Looks like we've got a nice audience here, about 60 some odd people attending. All right, let me start off by just saying thank you to everybody here that's joining, several advisors I see, several individuals. Some of you are familiar with our webinar, some of you are not, but this will be a very good educational conversation that is going to be led by my colleague, Melanie Schaffer, with the good folks of Trader Oasis, Oasis and OptionsANIMAL, talking about options, and they know a little bit about this space. So Melanie's going to lead off. For those that are here for the CE credits, I will be emailing you after this webinar. Just check your email. I'll get your information. I'll submit that information to the CFP board. And if you happen to be among other people that are into options or maybe are curious about options, tell them that this is happening. It's going to be a relatively quick 30-minute conversation, but one that I think everybody will enjoy. So with that, I will hand it off to Melanie and thank everybody again for joining.
Thanks, Michael. Yeah, and welcome, Eric and Greg. As Michael said, it's half an hour, so we're going to get right into it. Guys, let's open with something every investor can use right now, the collar strategy. How do you get real downside protection while still keeping upside potential alive in a market that's this jumpy?
So I'll take that one, Eric. The collar trade is a very dynamic tool, if you think about it. If you go to Investopedia or Wikipedia or wherever you want to get the textbook definition of a collar, it's a very locked down, safe strategy where you're combining a protective put option and a covered call option to basically collar your stock, right? Whether it's an earnings fear that you've got in front of you, whether it's a potential big sell-off in the market because you feel like the AI bubble is going to burst. And it's a pretty static trade, and then people are familiar with it from the textbook definition. But I think the way to do it that gives you a little more dynamic approach is don't think of it as a static trade, but rather think of your three instruments that I just described. You've got your long equity position, your short call position, and your long put position. But think of them as individual instruments that you can move in and out depending on the trend of the stock. You can structure them in different strike prices and different time frames to really fit your investment objectives. So if you wanted to still give yourself downside protection, it's a strategy that you can employ that gives yourself a lot of flexibility. I stumbled on the trade when the internet bubble was bursting. Gosh, 25 years ago now. I guess it's been a long time. I've been doing this for a while. And it really changed my perspective on risk. I don't have to try to time the market perfect when I use the collar. And that's what I love about it is think of it this way. It's an insurance policy that I can put on and take off when I see the hurricane coming or just during hurricane season. If you live in Hurricane Alley there in Florida, you're in hurricane season right now. And, fortunately, we haven't had a lot of them. But again, knock on wood, it's still really early in the season. But if I could just buy insurance on hurricanes during hurricane season, that's essentially what the collar trade allows me to do. It's a really cool trade.
Yeah, so talking a little bit more about risk management and the mastery of that. Most retail traders blow themselves up with sizing. Can you walk me through how size positions can make such a difference and can be such an expense, if not a disaster?
Position sizing is important. The bigger your portfolio gets, obviously, when you're trading several $1 million, if you've got a larger portfolio, it's important to not have all your eggs in one basket. But that's sometimes difficult when you're a retail trader and you're trading a $25,000 account. The beauty about the collar trade is the position sizing. You can still manage risk without position sizing. Again, the traditional RIA model tells you to diversify, and every investing house is a little bit different. Some might say, I only want 2% of any asset allocated into one equity, or I might be okay going up to 10% allocated into one equity. And a lot of times your decision-making process is defined by your client too, as to what their investment needs are. Again, the beauty of the collar trade is I'm not using position sizing as my risk management. I'm using options tools combined with my equity. So to be quite honest, I could have my whole portfolio in just Apple if I wanted to and still manage risk. And that, again, it all comes down to risk management and how you want to approach it. Now, the bigger you get, you're managing a couple $1 billion, maybe Apple's a little bit too much to say, I want all of my money just in Apple. And so you're going to spread, and that's not for risk management, to be honest. It's more for opportunity because there's other opportunities for growth outside of just Apple that you may want to expose your portfolio to. So for me, position sizing isn't as much about risk management as it is opportunity management.
Yeah, I'd like to piggyback on top of that. And you talk about position sizing, and a lot of people think position sizing, they think capital. And that's because the vast swath of traders out there are looking at equities only. And so when you trade an equity, you buy stock, your maximum risk is zero, is whatever you paid for the stock, it could go to zero. And so from a position sizing standpoint, if you use traditional metrics of, maybe 2% or 5% per instrument or equity that you're trading to your portfolio, certainly if you've got a $25,000 portfolio, you're really limited, or we even have people that are trading a $5,000 portfolio. However, the beauty of the collar trade is that we don't want to focus necessarily on capital, but we want to focus on risk. And Greg mentioned buying a put, and a put is literally an insurance policy. There's people who trade options for a lot of different reasons, and you can trade options for speculation, and there's certainly a lot of that going on. We can talk about that as an approach or as income, but you can also combine it and do risk management. And as an example, I was just looking at NVIDIA right now. So a trader could go out and buy NVIDIA for 170.65 a share right now and get a December put at 170 and a 180 short call. So one of the benefits of when you're trading options is it's a benefit, but it's also a challenge. Is we trade more than just stock direction. Too many people focus on stock direction. We're also trading or making money off of time. So theta, if those of you that are familiar with options, and volatility, Vega. So we can make money off of options. And you talked about volatility, and it's been mentioned here. Options become expensive when volatility is very high. We see implied volatility go up. The VIX is a good idea or a good example of an implied volatility measure that everybody pays attention to. We know when the VIX is high, options are expensive. So when you go to buy a put, it's expensive. But if you're selling a call as well, it's expensive too. And this collar trade that I'm looking at right now on NVIDIA, an investor could go out and do this trade with a total outlay of $17,833, and quite literally, because they have a long put at 170, between now and December expiration, the maximum that they could lose is $830. I'm sorry, $883. Literally $883. Cannot lose more than that. And if you just wanted to sit in this trade and try and reap, and it's a theta positive trade, and it's a bullish trade, so it makes money if the stock goes up as well. So Greg mentioned previously dynamic, and that could be a trade that literally you could go on a cruise for the next 3 months or whatever and not come back until, here we are in December and worry about this trade and see whether you're making profits or not in it. So this is the point that I want to get across is shifting your focus from just looking at capital, but also looking at risk. And that's where we can really dial in with a collar trade, the risk component. And from a traditional portfolio management standpoint, risk management is diversification, right? We hear diversification all the time. And certainly diversification has its place in an options collar type portfolio. It does make sense to have some diversification, but it's a very blunt and crude instrument to say that I'm going to have 4 different sectors, and if one goes down, this other sector, might not. If one sector goes down, it does. The other 3 don't. Well, that works until you have the global financial crisis, when the best performing sector was healthcare, was down 23%. And during that period of time, my portfolio was up 35% that during the global financial crisis. I was loving life because you can actually structure the collar to be literally anything. Can be a bearish collar, can be a bullish, can be a stagnant collar.
And I want to add to that performance in 2008, because I've known Eric for a long time. We worked together for a long time. I know that you were not positioned bearishly. You weren't Brad Pitt and Michael Burry from The Big Short, and you knew what was coming, and you were short credit default swaps, right?
I was not
Not that
bearish.
you were betting for the collapse.
I thought
right?
it was, I'm an eternal optimist. I thought it was over. I'm like, oh yeah, it's going to get better. We're turning around. This isn't the bottom yet. This isn't the bottom yet. But some of the best trades that I've had have been when a stock goes down. And if you're in a collar, you're okay with it. Now, there is a trade-off, right? So in a collar trade, we're selling a call someplace, which means we're going to sell our stock. And this is something that I think retail traders need to get over is it okay to sell your stock? I mean, if you're going to make, 30% annualized on a trade, that might be okay. Making 30% annualized to sell your stock. It's interesting how much confusion there is on covered calls. Barron's wrote an article about 3 years ago, and in there, as I can't find this article, and I wish because they took it down. I wrote a letter to the author and said, "Hey, you made a big mistake." But this guy said the risk of a covered call is if the stock goes higher and you sell your stock. And ladies and gentlemen, let me tell you, that is the exact opposite of risk. That is where the maximum profit is attained. Now, you may not want to sell your stock, and maybe for tax reasons or some other reasons, and there are prudent things to adjust. And actually using a collar trade is pretty interesting because if you buy back that call, so you sell a call, stock goes higher, that call ostensibly becomes more expensive. If you don't want to sell your stock, you buy the call back and you book a loss. So there could actually be a tax benefit without selling your stock, realizing a tax loss harvest off of the call. So there's a strategy that works there. But I think most of our clients at OptionsANIMAL recognize that, hey, selling your stock is something you should celebrate because that's where you hit the maximum profit.
Yeah, so I want to get a little more into this and talk advanced trade adjustments. Greg, trading Apple is your specialty. With the September 9th event coming up, show us how you'd plan the trade, define risk, and then adjust if the stock sells the news, step by step. What do you do before, during, and then after the move?
Well, I want to talk a little bit about Apple. I love the stock. I've been a fanboy for years and years. I was a fanboy when it was just the iPod, not just the iPhone. That's how long I've owned Apple and have traded it. I'm very concerned about the fundamentals of Apple. There's a lot of hope in this September 9th event that we're going to get a better battery life out of iPhone 17. We're going to get better cameras. At the end of the day, it's still just another iPhone. And I believe Apple, from a product development standpoint, is losing the edge that they've had for going on almost 20 years now. Because they've failed to develop. I mean, they're trading at a forward PE of almost 30 right now, whereas their earnings growth is somewhere in the 8% range, 9% range, forecasted for the next 9 years. I mean, that's an expensive stock. I know there are other companies that trade with higher PEs. NVIDIA, another one of those we just talked about. But the difference with NVIDIA is their earnings growth is in the double and triple digits, sometimes quarters. And so it's easy to justify a higher valuation. So for me, unless Apple absolutely surprises us with, and again, what's the name of it's called the
Jaw dropping.
Awe dropping, right? Yeah, awe dropping. I hope they surprise us and that there is something in there. But the market right now doesn't show that it is. I mean, if you look at the current 30-day implied volatility on Apple, it's at around 21 right now, which is historically pretty low.
Yeah.
So from a trade standpoint, that actually makes it interesting to trade the event, both if the event becomes a disappointment or an excitement. So you could structure it in an equity trade if you own the shares. You just go buy the stock and you buy a married put along with it. You go buy, actually I haven't looked at an options chain yet.
I've got a vanilla collar right set up here on Apple.
Have
if
you
want
got
to
a
talk
vanilla
about it.
collar? I was going to say a vanilla collar might be the best way to play
Well,
it. Right?
that's, Greg. So Greg's background, his dad he's a farmer from Idaho. He's also a fabulous fly fisherman. But Greg grew up watching his father trade wheat, and so selling options around futures, he came about it from a different perspective. And Greg's been doing this his whole life, just teaching other people how to trade options. I looked what Greg calls a vanilla collar. It's really where we start people say this is a collar to look at. Now, real quick, so if you think about what makes up a collar, it's a long put and a short call. And if you think of a matrix in terms of moneyness, so in the money, at the money, out of the money, and then you can think in terms of duration. It could be short term, intermediate, or long term. So if you put that together, it's a it's a 9 square matrix, a 3 by 3 matrix. So you can have your put anywhere in there. And the same thing with a call, you can have it anywhere in there. So technically there's 81 different versions of a collar trade. And the first collar that I mentioned is a collar that does well. This NVIDIA structure does well if NVIDIA goes up. It's got protection to the downside. Now, Greg has taught me, and I've been doing this for 22 years working with him, taught me that if you're around an earnings event, the type of collar you probably want to look at is a 45-day at the money long put and an out of the money short call that's maybe 120 to 90 days. And I've got one set up right now that the absolute worst thing that could happen is if the stock went sideways all the way till expiration, you would lose $239, literally $239. Capital outlay on this trade is 23,781. But I'm looking at a long put at 240 and the October monthly expiration. So October 17th, 240 long put for 735, a December 19th, 250 short call for 747. So those two just basically pay for each other. This trade, if the stock goes down, you make $218. If the stock goes up, you can make somewhere on the order here of, I think it's $1,200, $1,246. So this trade, if you look at it from an option trade that people are familiar as a straddle. So a lot of people want to trade a straddle. You buy a call and a put and the stock explodes in one direction or the other. Anybody that's had experience with that knows what happens when there's volatility crush. So the stock does move, but implied volatility goes down and you probably don't make money. You need a massive move in order to make money. This trade has a 36% probability of losing money. So for a trader who says, listen, I know the stock's going to explode. It's either going to go up or it's going to go down. Now, so this trade's going to make money in either direction. Now, you do have a cap on the profits. And as Greg mentioned, this is a dynamic trade. So after the event, the day after the event, I'm adjusting this trade depending on which way it goes. If the stock moves up, I probably want to take the put or maybe roll the put or maybe sell a put against it. There's multiple options. And if the stock's going down, I'm probably rolling my short calls down. But in this trade, this is the thing is all the emotions of fear and greed are gone. Before you do this trade, you know exactly how much money you can make and how much you can lose. And all you want to have happen is for the stock to move. And as I mentioned, the way that you lose money on this trade is if it goes sideways for the next 45 days. And you would be crazy to stay in it for 45 days if it goes sideways.
Yeah, because really you're putting this trade through the event in a week. You get through the event in a week. If the stock doesn't do anything, you tweak you close the trade down. Now you just own the stock again. But if the stock's just doing nothing now, you're still in an equity position that you could turn into another type of strategy. That's really this concept of adjustments that we teach at OptionsANIMAL is, so many people use risk management in trading. They use a stop loss to manage risk. And NVIDIA is a perfect example. Apple's been one in the past, but this year has been a perfect example of how stop losses are so hard to use on trading some of these big market momentum names because NVIDIA has had so many stops and starts this year, whether it be the big gap down at the beginning of the year that we had when DeepSeek that China said we've got this competitive platform that's going to dethrone NVIDIA, and we had the 30% or the 20% gap down overnight. A stop loss gets absolutely blown through in that. You don't get filled. A mistake I think investors make about stops is they think, well, it's going to protect me at 10%. a stop loss doesn't guarantee a fill price. The only thing in my experience that a stop loss guarantees, it guarantees I just lost. And so for me, a better way to control risk is this collar trade idea that I can still play the name. I don't have to try to pick the tops and bottoms perfect. I don't expose myself to gap moves. Yeah, it takes some of the upward explosive move out of the market. I'm not going to double my money in 30 days doing a collar trade, but I'm also not going to lose money. And to me, that's what I have figured out over the years of trading and investing is that staying in the game. You don't trade yourself out of the game. So many people use strategies and great strategies to make money in the market, and then they start to overexpose themselves to risk and blow their account up, and then they're gone.
And so we're running out of time quickly, and that was excellent. But I just want to pivot for a minute and talk a bit about diversification. And a lot of investors think that means owning more tickers. You say it's really about controlling outcomes. What are people getting wrong then about inflation debt and diversification, and how does option structure fix that?
Well, again, for me, diversification is still a tool that can be used and should be considered in a portfolio, but it's not what traditionally diversification is pitched for. Again, we're told that diversification is to protect against risk management, and to me, most 60-40 portfolios, if you look at studies, they're 98% correlated to the move of the S&P 500. It's not really diversification. And I'm going to go back to what Eric said. What I would rather do is look at risk management and diversification. I can control risk with instruments, with options. The diversification need is like I've been saying about Apple. I've been a fanboy of Apple for a long time. I don't trade it nearly as much as I used to because it's not the opportunity that, say, a name like Palantir or NVIDIA is right now compared to what Apple is. So I diversify. I know it doesn't sound a lot like diversification when I'm saying go from NVIDIA to Apple or from Apple to NVIDIA, right? They're both still high-tech names, but there's a lot of opportunity in other places too. Financials are great trades. Energy is a great trade right now. Particularly, it's tied to the need for the AI data centers that are being built out. Gold is a great opportunity right now, all-time highs and some of the gold miners. So for me, diversification isn't about spreading my risk because I can control risk with options. For me, it's spreading opportunity and taking advantage of other hot sectors in the market that may be a better return than Apple is right now.
Yeah, so just to finish off, Greg and Eric, this has been a fantastic session. For anyone who wants to keep learning, where should they connect with you to see more about the approach and get the live education?
Did Colin give us that link, Greg?
He did. He actually texted it to us. So the link is ready. I don't know if you can find it in a text message, Eric. There's actually a QR code, but the link.
It's optionsanimal.com/LLM, lead lag marketing.
Lead lag marketing.
Yeah, LLM. So large language models, if you remember. So that's probably Colin's. Yeah. So there's that'll take you to the Options Animal website. Now, let me just throw out there at Options Animal, we're not registered investment advisors, although some of us have registrations, and there are plenty of them in our community. We actually train a lot of the people to either manage their money or their clients' money, and there's some significant accounts that we know of. But anyways, we use real money. And just to put things into perspective, I started sharing just one account and that I have, full kimono for some of our premium level subscribers. On January 1st, 2023, it had 113,000. Today it's 211. So it's up over $98,000 on an annualized basis. It's 32%. And that's the sort of returns that I've consistently been able to generate. And here's the benefit. You listen to Greg talking about trading Palantir. Some of you might be thinking, oh, I can't handle the risk. The collar trade is perfect for you. You can still get into these big names, these NVIDIA, even Open, which is getting a lot of, it's the next meme stock. By using collars, you can really dampen the risk and not experience the same sort of losses that other people will. Now, there's always a trade-off, but to put it in a ballpark, I think 32% annualized return over the past 3 years is pretty good.
Yeah, that's amazing. So everyone can go and check out that link. And thank you for joining. And Greg and Eric, thank you so much.
Let's do this again, Melanie. It's a lot of fun.
I know it was great. It was great.
Can I just say real quick, when Greg said that he looks back to the iPods, I was like, so Greg is basically 207 years old, is what
Yeah.
that's how long ago the iPod. Anyway, thank you everybody for watching.